before I go into the slides, I do quickly just need to just alert you to our compliance slides. So I'm just going to quickly go through those, and if you can just read them as I just flick them through, because we will be talking about trading content and some trading ideas and concepts. So we will be talking about trading in the futures markets for any of the new traders that are out there, or people who are non-traders. And just be mindful that this presentation is general information only, and no professional or personal advice is given to you in terms of we don't take into account your financial objectives or your financial situations. So everything is all general advice. All right, so reversal trades. So I see the reversal trades. Well, what I'm going to cover in this masterclass is 3 points. It's going to be about the mindset behind the trades to make sure that the mindset you're using is aligned with what you want to create ultimately in your trading. Number 2, the foundations of reversals, and also to understand the market better to fine-tune your approach. Now, just be very mindful whenever you're trading that your trading style isn't based on fear. And that's what I find with a lot of people who are looking to take the reversal trades. They're coming from more of a motivation of fear rather than what they want to create. Of course, they want to get the target, but their initial reaction is that adversity to loss or that adversity to risk, and they don't want to be in the market for a very long time. And I understand that, and I get that, but be very careful that your consciousness is not focused on the loss. And the reason why I say this is because loss, just like wins, are very equal and normal and acceptable part of trading. So what I really want you to understand, and this is for the new traders, I know the experienced traders really get this, but the traders that are very new to trading or people are thinking about trading, one of the biggest reasons why traders fail is because what they're resisting, example loss, actually persists. So be very mindful of where your focus is. So if your focus is on avoiding loss and therefore coming from a fearful state, you actually have a high probability of creating that overall. And as we know, the more you focus on loss, the more you actually create the loss. You'll find that more losses will come. So how we want you to think about losses is to think about them as just a normal part of business. It is a part of being in the markets. You have equal number of wins. Sometimes you can have equal number of wins and losses and still be profitable. It all depends on your risk to reward. However, treating wins and losses as equal and as without the emotional response is very, very powerful. Right? And this is the training that you really need to work on being a trader. And Kelly, being our mindset master, will talk more about this, I'm sure, in her presentations later today. So I like defining trades or breaking trades up into 2 categories. You've got your fast trades, like we saw from Mary O and Simon, super fast trades, trading that opening sessions of those, the DAX and also the S&P 500. Very quick, very, very volatile moving candlesticks. But there's also the slow trades as well, which you saw Greg, take that slower, more continuation type trade. But I'm going to focus on fast trades for you because we are focusing so much on the fast trades these days, and a lot of traders do like them. But be mindful where your mind is when you are trading and why you are trading a certain style. If it's coming out of fear or focusing on loss, you may need to look into that a bit deeper and think, why do I think like that? Anyway, there's going to be lots of time to discover your mindset throughout the markets. So let me talk about some of the foundations for your reversal trades and how you can tweak your strategy to really fine tune it, because there's not one way to trade, or there's not one thing that makes up a trade. Generally, a trade, you're processing a lot of information, you have a lot of variables that you're taking into account. For instance, Fibonacci levels. You've got previous days high and low are very significant levels. You might have the gap, And we saw how reactive the market was off the gap and also back to the gap from those presentations from the knockout traders. Round numbers are really significant areas to look for when setting up your reversal trades. Other brick walls, other IDTA brick walls are also very powerful as well, as we saw from Mary in that first trade. I think she traded off the R1. And then also significant Fibonacci levels. So there's an insurmountable number of levels out there that you can look for to wrap your trades around. However, whatever you do, you just need to be very consistent about it. Be very clear, and sometimes too much information can create analysis paralysis. And as we know, trading's very, very fast. You need to make quick decisions in the moment. And if you've got too much information, sometimes we don't make any decision at all, and we let those trades go past. And then we go through the emotional roller coaster of, oh, I should have got in, oh, I should have, could have, would have, and then you chase the trades and those sorts of things. So keeping your trading plan simple and looking for very, very obvious mechanical references, I call them, and those ones up there, I think they're the most mechanical and visual references. I don't get too heavily involved in the Fibonacci levels so much. So apart from the 50%, I find the 50% is a very powerful level on a range or within a market context. Now, with any trading strategy, it's very, very important. You just don't, as I said before, you just don't take the trade just based on one thing alone. You have to take into account the wider context. And that's what I bring to a lot of our traders, particularly through our TBS program. I really help them to understand the wider context and to read the market in a larger story, just to take your mind out of the sort of the minute details sometimes and to just have a bit of a broader perspective. And that, I feel, helps with our traders with their confidence of reading the market story. Now, with these fast trades or these reversal trades, you do not want to be in the trades for a very for a very long time. They're a fast trade, and that means you get in, you get out. You don't need to be hanging around in the trade for a long time, particularly if you're trading off a visual reference point. And the reason being is that those visual reference points in the market are seen by a lot and many traders. And generally, those short-term traders that are trading these reversal trades are weak, short-term, or what we call weak hands traders. And what weak hands traders mean is that we don't have a large stop loss. We can't allow the market to breathe for a long amount of time and go through a lot of chop. We need the market to bounce off the level, pay us quickly, like we saw with the knockout traders, or the first two examples. We want to get in and out of the market very quickly, and we don't want to hang around and just fall in love with the trade if it doesn't do what we want to quickly. That's very, very important. You need to manage your risk very quickly on these fast trades. And we could see that with the examples from the traders. Now, the first thing I really want you to focus on or learn about as a fast trader or as a trader of any type is that there's 3 prime players that are in the marketplace. Now, I'll go into that very soon. I'm also going to talk about the overnight inventory and what overnight inventory means. So these are new concepts that you would never have heard, or some of you may have heard of. And I'm going to also talk about the market. Does the market open in balance or out of balance? And what I mean by open is generally the major market opening times. So for instance, if we were talking about the FDAX, if you're an FDAX trader, the open of the FDAX is 5 o'clock. There's data before 5 o'clock, which is the pre-market data, which is what we call the overnight data or the overnight trading. However, as an open trader, if you're trading the S&P 500 or the NASDAQ, what we need to focus on, if we're trading the open of that market, we're comparing what happened from, say, all through the Asian session and through Europe. That is what's called the overnight session. And then when the market opens, That's the regular trading hours, the cash market open. That is what we're using as the reference, right? So we're looking at two different sections. So, and I'll go into more detail when we get into the charts. So these concepts are maybe a little bit much to get your head around, but with practice and with eyes on the charts, you'll get to see that. So I'll give you plenty of examples today. So there's three primary players in the market. You've got the daytime short-term traders like us. You know, most of the IDTA traders don't trade overnight positions. We don't have multi-million-dollar trading accounts, maybe some. However, most of us has fairly small, moderate accounts, and we're in and out of the market. We're looking for short-term trades. So the second type of trader or investor is people who use investment capital. They're generally large money managers, and they're generally slow, long-term traders or investors. They are staying in the market for a long time, and they generally can only buy the market. And that's the reason why they can only buy the market is they're limited by federal law. For instance, pension funds, or what we call in Australia superannuation funds, can only trade in one direction. Then there's the third type of traders, and these are probably the most aggressive traders in the marketplace. They have huge pools of capital. You know, some of you guys may even work for one of these types of funds, or you may aspire to work for one of these massive fund trading organizations. So they have large pools of funds. They're highly leveraged, which means they borrow a lot of money as well to be able to trade larger positions, and they're very aggressive. So they're the three types of trading entities in the market. And it's very important to understand how all these play a part in the market. Now, the next point I want to talk about is the overnight inventory. Now, there's two primary sessions in a trading day. So there's what's called the ETH, or the extended trading hours, or what we call the overnight. Then there's the RTH, or the regular trading hours, the cash market hours. So, for instance, the European markets like the FDAX, their cash market hours start from 5 o'clock and they go through to 6 o'clock. The S&P 500, NASDAQ, they open at, if you're based in America, it's 9:30 Eastern time, 8:30 Central time, and close at 3:30 and 4:30. Sorry, 3 o'clock and 4 o'clock. Now in Australia, or different varying time zones, but for Queensland, at the moment, the market opens at 11:30 p.m. for me, and in New South Wales, Victoria, it's 12:30. That will be moving an hour when the times change in the United States. I'm not going to go into that. Now, if you're trading the regular trading hours, so if you trade the open of your market, it's very important to notice where the market is trading in relation to today's gap. Now, there's three possible scenarios. Now, for some of you guys who don't know anything about trading, the gap is where the market closed the prior day. That's a very important reference point, and I'll show when we get into the charts. So there's three possible scenarios. There's one possible scenario is that inventory, which is the contracts that are being traded, the inventory for that day is long, which means that short-term traders during the extended hours or the Asian market leading into the European market have moved the market higher. So we would assume that those people trading in those extended trading hours are weak hands traders, which means they can't hold large risk, they can't hold large positions. So they can hold large positions if they've got huge accounts, but generally weak hands traders don't want to be in the trades for very long. All right, or if the market turns against them, they exit their positions very quickly. And that creates a string of stop losses, stop runs, and we start to see a momentum and a drive in the market back the other way. So that's one thing we see quite often is if the inventory was long, that coming into the open of the market, that inventory gets corrected, the price gets corrected, and the market comes back and tests the gap. Once again, this is just probability. There's a very high probability. Does it happen all the time? No, There's times where it fails. But that type of information can tell us another thing that could be occurring as well. So there's lots of information we can gain when things don't happen like we expect them to. We need to have the mental flexibility to say, hey, look, there's something's changed here, which isn't normal. There may be an opportunity to trade it the other way. Now, the second opportunity or the second scenario is the market is trading short. What that means is that the market has traded below the gap and that traders think the market is going to be negative for the day. So they're trying to front run the market, maybe get in early and drive the market down. Now, if we know, and a lot of professional traders will basically hunt these short-term traders. And if these short-term traders are short and the market starts reversing and going long and going back the other way, we're seeing that inventory being corrected. And we get a stop run and the market goes and closes its gap. So we see that happen a lot of time. Now, when you start observing this or when you start knowing this, it's going to waken you up to, wow, there's a lot more going on than what I first thought than just candlesticks. Now, the third scenario is when inventory is balanced. And this is when the market opens evenly. You'll see that the market may have traded above the gap, below the gap, above the gap, below the gap. So it's just been market just what we call pickpocketing each other and not really any clear direction or sentiment or strength in the market. So that's a balanced inventory. So let's have a look at some examples. So this is all from the S&P 500, and this is a 30-minute chart. I like using the 30-minute charts because they clump the data in a nice compact area, and also because the US markets start on the half hour. I find them a little bit better than a 60-minute because they take into account each 30-minute period, which is important. So when you see the boxes on the charts, you'll see the ones that I've highlighted in green, the green color. They're the regular trading hours. Now the blue colored or the purple color, they're the overnight trade. So if we have a look at that example there from the day of it's the 21st, we can see, and if you're looking at the purple box, you can see where the gap is. So you can see the gap from the 20th of the 9th, right in the middle of the chart. It's that red dotted line across the middle of the chart. Now the gap is where the market closed on the prior day. It's a very significant reference point. So what's happened there is that the Asian trade and the Euro trade has tried to trade higher. So the inventory is considered long. Now, when the US traders come into the market, they're all like, okay, where's this market situated? All right, we can see that there's a fair few traders long. We're going to try and drive this market down. And you can see on the opening, I think the opening hour and a half, the market eventually closed the gap. So what happened in that situation is that traders that were long had to get out of their positions and the market sold off, cleaned out the gap, and then there was the reset of the market. Then there was some new opportunities for new traders coming into the market, or the market could then do whatever it wanted to do after that. But if you're a short, sharp reversal trader like a Simon Wong, and you're just trading that opening 5-minute candle, of course, looking at a 30-minute chart is not going to give you, in that tiny little moment in time when you're just scalping that money out of the market, it's not going to give you a trading signal. But what this is going to do is going to set up some context and some understanding of what maybe larger players are thinking, what smarter money's thinking, and that maybe that the market could be moving back to these levels. All right, so these are not trade signals. These are trading concepts and trade ideas. And the more you watch it, you'll start to get in feel and in sync with the market. So that's a classic example of inventory was long, and then the market balanced itself out during the open hour or open hour and a half of the market. So here's another example. We can see here. So if we look right at if you can see the gap on the 24th of the 9th. That's the first example I want to show you to. So the first or the second purple box, or that large purple box on the left-hand side of the screen, look at the gap level on the 24th of the 9th. Now, we can see at the start of the session, or the start of the Asian session, the market traded higher. So inventory was long at that point. Then coming into the, you can see we've got an MDI change on that 30-minute chart, and we can see the market has come down and closed out the gap. And then you can see what's happened in that at the start of the 27th, because obviously that was a Friday, the 24th, and then the markets opened on the 27th. You can see that what's happened is the gap has come from the 24th, which was the Friday, but you can see on the 27th of the 9th, the market's opened, and then it's gone up and it's actually filled its gap once again within the first hour to an hour and a half. So the inventory was probably short coming into the opening of the market. However, the market went back and closed its gap in that first hour to half an hour, or at least attempted. So we can give you a little idea of where the market's going to go. And that's really, if you're just looking for one trade, that's all you need. You don't need too much time in the market. Now, the second example on this example is the market is very short at the start of or during the Asian and European session. And you can see what happens in the green section on the 28th of the 9th. The market doesn't go up and fill its gap. And this is a nuance. It's very important to understand. And this takes time to get this. But what's happened in this situation is that the market has gapped down. So the US opening traders, or the US open traders, have opened the market, and they've basically kept going down lower. So in this situation, we've had a huge gap. And sometimes when you get a very large gap, it's virtually impossible that the market will try and will go back and fill that gap from the 27th of the 9th. Because of that huge amount of space between where the market opened and where the US market opened, that is what we call a gap in the market. And when you get those large gaps, it's very hard for that gap to fill, and we're likely going to see momentum going in that prevailing direction. And this is where we saw the opening traders just take off and go short very, very quickly. So that's a market nuance I really want you to pay attention to. If you're trading the open of any market, just watch how large the gap is, because it could be a sign that the market is quite, in this situation, quite weak, and the sellers are in big command, and they're going to keep driving this market lower. So that's your overnight inventory, and using that as a reference point is very, very important for understanding that. There's a few more examples of overnight inventory there, and you can see, I'm not going to go into too much detail there because I've got a lot more to cover. But you can see, once again, if you look at the middle example there, you can see the gap from the 23rd of the 9th. The market was trading lower, and then on the 24th of the 9th, the market opened up, cleaned its gap up. So you'll see this happen over and over again, particularly when the markets are balanced, and when you see the ranges are very, on the daily charts, are very side by side and overlapping. Now, here's an example of, I'm going to talk to you about the RTH open, in or out of balance. And I kind of showed you an example just before that last, or the second slide I just showed you, where the market opened way out of balance and the market kept going lower and lower and lower. That's an example of what we're going to talk about here. But there's two possible scenarios. When the market opens in balance, it just means that the regular trading hours opened within yesterday's regular trading hours. The second scenario is out of balance. So that means the regular trading hours opens outside of yesterday's entire regular trading hours range. Right? Not the whole range of the whole day. We're only talking about the regular trading hours. And the reason why we focus on the regular trading hours so much is because that's where the majority of volume is traded. So the regular trading highs and lows are very important reference points. The other highs and lows, so the extended trading hours lows are and highs and lows are important reference points as well, but really only for that day, not so much the days are preceding or after that day. It's really on that day is that traders will look at what the extended trading hours have done. However, the regular trading hours are most important when we're talking about if the market's opened in or out of balance. So what happens if the market opens in balance? So if the market opens within prior day's regular trading hours range, we're likely going to see rotational trading, which means the market is going to, we're not going to get we might get some nice trends on the 5-minute chart, but we're not going to probably get huge trends or a trend where the market opens and finishes on its high, or a big sell-off where the market opens on its high and trade and closes on its low. We're not going to get those big runs. We're going to get moves, which is all we need in the market on a 5-minute chart. We don't need huge moves. But what's going to happen is likely what we're going to see is that we're going to get a rotational day. So from the start of the day to the finish of the day, we're likely going to see two-sided trading, which means the market may go up, may go down, may go up again. But the market's really going to just oscillate between likely the high and the low, or the high, the 50%, the low, the 50%. So we're going to get oscillations. And this is very important for you guys looking for reversal trades, because you can look at these regular trading hours highs, prior days highs, as very key reference points to look for trades to trade away from those levels, particularly in these balanced days. Now, the second scenario, if the market opens out of balance, we're likely going to see a trending day, and these are going to be great for those continuation trades. So those big long trades where you want to milk a big long trade. If you're a slow trader and you like being in the market for a long time and you like going for large targets, then these are the kind of days that you're going to absolutely relish. So there's a lot going on in this chart here. So what I want you to first focus on is, I think the most important thing to focus on is, I'll give you an example of out of balance. So we can see, if you look at the far right-hand side of the chart, if you look at the green box, the high of the 28th of the 9th, you can see that the market has opened lower and well outside the prior day's range. Now, the prior day's range was the 27th of the 9th. The prior day's range was a very tight range. It was a tiny little balance day, all right? And it was within the prior day's range. So if you look to the left, you can see that that little box is inside the smaller green box from the 24th of the 9th. So what's happening here is, number one, on the 28th, the market has opened well and truly out of balance. Now, because it's gapped down so low, there's a possible scenarios. Are we going to see the market go and try and fill the gap and go back and go at least back up to where the market closed the prior day? That's one scenario. But as we know, because the gap was so large, there's a high probability that this market's going to continue trading downwards and maintain out of balance. And this is quite common. We've been seeing this occur a lot over the last week on the S&P 500. We've seen the market actually trade up, trade out of balance, and just keep going and finishing out of balance. So we've been seeing this scenario occurring on the high side. And that's why we were so confident the market was going to retrace or keep going back and retest the highs. And that's what we've seen. Last night, we saw the all-time high get broken. And then what did we see off the all-time high? If it was anyone was trading the S&P 500, we saw quite a strong reaction off that, and we saw some reversal trading off those all-time high levels. So now, the example before, all right, so a day in balance. So you could see the market opened on the 27th of the 9th. You could see the market opened well and truly inside the balance of the prior day. So if you were opening up your charts and you were trading the open of the day, you'd be going, okay, we're likely going to see the market is going to be two-sided trading. We're going to see the market potentially go up or go down and go up, but we're going to watch to see how the market trades. And the key reference points will be the highs and lows of the prior regular trading hours. we can see the market actually filled the gap on that particular day and then didn't really do much from there. So there was a nice short opportunity off the gap, never even got to the prior day's high. And that's another sign that the market was potentially weak because we couldn't keep going high. Particularly after what we'd seen 3 or 4 days leading into it, we'd seen the market go up for a fair few days in a row. Then the market had found what we call a 3-day balance. And a 3-day balance is where you get those 3 green boxes all sort of in the same vicinity of each other. And as you can see from those green boxes, you can see that the markets within those days, particularly the 24th and the 27th, were quite rotational days or sideways days. We didn't see huge trending days. The 24th trended a little bit, but it was quite a grinding, not a very strong trend. So very important to understand where the market opens in terms of prior day. It can give you great information into what is likely going to happen. And remember, trading is all about probabilities, right? It's not just one thing. You've got to weigh up all the information that you've got to work out what is the best trading opportunity for you. And the more confidence you have in reading the market, the more confidence you are in placing your trades and being confident in knowing what you're going to do and not hesitating and not making the decisions when you should. Here's a couple of examples for the reversal guys off trading off round numbers and also a breakout day. So remember when I said at the start, traders love trading off these mechanical reference levels. This was a great example back in October, around about the 12th of October. We saw the FDAX market in the pre-market gap down. It traded out of balance in this situation, but it filled its gap fairly quickly. It probably took about, and once again, these are 30-minute charts, it took about 2 hours for the market to fill its gap. But the key aspect of this trade was look at the mechanical reference point, 15,000, a super round number. So many eyes could see that trade. The market also, based on overnight inventory, the market has opened short as well. It's gapped down a little bit, not a massive gap, a fairly decent gap, but not a huge gap. But look what the market did. It failed at the 15,000 level. We didn't see continuation to the downside. Therefore, what would you be thinking? Well, the market's going to try and go up and close the gap, or at least test yesterday's low. That's the first reference point we're going to look at. And you can see there was a bit of indecision at yesterday's low. You can see how the market bounced or stayed down there for around about an hour before it moved through and closed its gap. So that's a very mechanical reference point for those reversal traders out there. Here's another example of a very mechanical reference point. You've got yesterday's high. So the market's opened up, it's come back, tried to close the gap, couldn't close the gap, but looks where it's failed. It's failed twice. You've got double failure. As Mary mentioned, you've got double failure right at a very well-known reference point, being yesterday's high. The market couldn't close the gap. Okay, something's changed here. We could be seeing momentum to the high side. So you can see when you start to get into the flow of the market and you start to understand how traders behave around these very visual key reference points, your trading is going to absolutely blossom. You're going to start, does it mean you're going to win every trade? No, but you're going to feel more confident in where you're getting into the trade, and your location trading is going to be absolutely on point. And if it doesn't work out the first time, that's okay. Just wait and see. Just watch how the market behaves around the reference point. As we know, the markets don't always do what you want to do when you want it, right? They've got a mind of their own. However, if you can get in sync with the minds of the traders, what the big money and the smart money is thinking, well, they want to take advantage of weak hand traders, right? They know where these reference points are, and if the reference points don't hold up, then the market's likely going to go back the other way. Remember to look to see who's failing. If you've got a very strong reference point that's failing, well, it looks like there's going to be a lot of traders that are going to get stopped out because they're trying to trade off the reference point and they get trapped. And that's why I say, don't fall in love with a trade. If you're a reversal trader and it doesn't work out quickly, don't fall in love with it. Because if you're trading off a key reference point and it doesn't quickly pay you, then that's okay. You might not be ready to move. Just wait and see what happens around the reference point, or trade it back the other way. So there's always many options. It's all about you being flexible in your mind and in sync. So in reference, I think in conclusion to this whole, I've given you a lot of information. A lot of the information I go through is what I cover in TBS. So it's quite advanced concepts, but it's really, from my understanding, from my perspective, I've been working on this stuff for quite some time, and it's really improved my trading. I'm just so more confident in what I do, and it really has helped me to hone in the way I trade and what I look for. So the key lessons to being a trader, but also to being a reversal trader, is making sure you have time to prepare. Prepare your reference points, do your pre-market analysis to make sure you're in sync with where the market's likely going to go. You're going to have scenarios. There's never one way. So never fall in love with a direction. There's ultimately many scenarios that could play out, but you've got to look at which one has the higher probability. So get your probabilities in order. Have clear, consistent reference points. Now, I've got some very clear, simple reference points that I look at that I shared with you. So the half back of a range, or the 50% level of a range, yesterday's high, yesterday's low, and the gap. They're very powerful levels. Round numbers as well. Some Fibonacci's as well. There's many different reference points, but you've got to really hone in, which is important, and what you really see, what works for you from your testing and your time in the markets. Think in probabilities, all right? It's not 100% absolute set in stone that every trade is going to go your way, right? Ultimately, yes, of course, we want to focus on the win. However, losses do occur. As we know, don't get so hell-bent on the loss. Losses and wins, they're all a part of trading. If you focus on the loss and you focus on fearing and avoiding the loss, guess what? You're going to create more of them. It's just the law of the universe. It's how it works. The law of attraction is completely in play in our lives. If you believe it or not, if you don't know about it, it's happening. So focus on what you want to create. Focus on winning trades, but know that, hey, I don't always win. It doesn't always work out that way, but it's not about wins and losses. It's about trade management. Trade management is the key, and learning and becoming more confident and making fast decisions without hesitating. The importance of overnight inventory. I can't stress enough, as a beginner trader, as a weak, short-term money trader like I am, to be mindful of what your competition is doing. All right? When those traders are opening the market up, you've got to watch and see where they're positioned, because that can be one of your first early references as to where the direction of the market is likely going. And as we say in the live trading room, just watch and this market may fill its gap. Well, now you know why, because it's generally an inventory correction from weak hands traders that can't afford to be in the market any longer. So trading's a brutal activity, right, guys? We do take advantage of other traders in the market, but we want to be the smart traders. We don't want to be the cannon fodder out there that's just chasing trades and getting in bad positions, right? Or getting what we call short in the hole. Sometimes people get really short in bad places, but you want to be able to get into the market in good places. So wait for failure, look to see these markets trading off these reference points, and just back yourself. All the best, guys. Have an awesome conference, and we will see you at the sometime during the day. I don't know what's going on from here, but I'm sure you're going to get lots of great information out of the next masterclasses with Kelly and Lockie.
So before we go to morning tea, I'm just here to cover a few little logistics with everybody. So we'd like to let you know what's in store for the afternoon and go over the agenda quickly, please. Wonderful. So if you can scroll down, Kevin Wong, our AV extraordinaire, so I can see where we're up to. We're about to go to morning tea, guys. We're coming back with another incredible mindset masterclass with Kelly Lowry, our mindset mentor.